Welcome to the Pro Ticker Deep Dive. Today we're looking at something pretty significant, a really abrupt shift happening in the Andean emerging markets. We're talking Chile, Colombia, Peru. For years, these markets often saw local institutional investors being quite cautious, lots of political noise, economic turbulence. But this past August, something changed. We saw what looks like a major turning point. We're going to discuss what happens when the real giants of local finance, the biggest, longest-term players, the pension funds, basically change their minds and start buying again. And buying with some serious conviction.
Yeah, that internal reversal is really the core story. I mean, global investors, they're kind of used to volatility in this region, but the data we're seeing suggests this pivot in August was driven almost entirely by local capital flows. We're talking about the really foundational money, the sticky money, making a significant move. So our mission today is to kind of synthesize the macro factors that allowed this pinpoint the specific countries and even stocks driving this big liquidity surge. And ultimately understand what this influx of, well, sticky money means for the market structure, liquidity, risk going forward.
Right. So the key question we're trying to answer for you, the listener, is pretty straightforward. Why are these local institutional investors suddenly, piling into their home markets after years of pulling back? And maybe more importantly, what kind of signal does this send, this foundational confidence? What does it tell global investors who might still be watching from the sidelines?
Well, to really get the impact of this pivot, we need to remember the recent past. It hasn't been easy for the Andean economies over the last, say, 3 years. You had the pandemic aftershocks, right? Then add in significant political uncertainty, rising global inflation, and central banks had to tighten policy pretty hard to control prices.
Yeah, a tough environment.
Exactly. And all that instability basically forced institutional investors, especially those huge pension funds, to be really risk averse. They were aggressively trimming their equity exposure, holding back capital, and frankly, they missed out on a lot of the global rally we saw post-2020 because of it.
Okay, so let's unpack what finally changed. What allowed that, dam to break in August?
It seems like a couple of big things shifted.
Right.
First, inflation across the region is finally starting to moderate. It's easing off. And that gives the central banks room to start thinking about, well, easing monetary policy. That change in the cost of capital is huge.
Yeah, that makes sense.
Yep.
And the second thing?
The second thing, and this is crucial, is valuation. Because these institutions were cautious for so long, local equities in the Andes just started looking incredibly inexpensive. I mean, really cheap compared to developed markets, and even compared to a lot of their emerging market peers.
So stabilizing economies plus cheap prices.
Exactly. Kind of the perfect launch pad for this pivot.
Now, you mentioned the type of capital involved. Why is that distinction so important here?
Yes. This is critical. We often talk about global capital, right? Sometimes people call it hot money or fickle capital. It flows in, flows out, often based on short-term things like commodity prices or what the U.S. Fed is doing.
Right, very sensitive to global news.
Precisely. Local pension funds, though, they're the complete opposite. They are the definition of sticky buyers. Their job is managing retirement money over decades, not weeks or months. So when these huge long-term players decide to increase their exposure, it's not just short-term speculation. It's a fundamental allocation decision. It signals they see multi-year stability, or at least the potential for it. Their re-entry is probably the most powerful validation you can get for market recovery starting.
Okay, that framing is important. And when we look at the actual numbers, Chile seems to be where the action really was. It's the heavyweight here.
Oh, absolutely. Chile is the undisputed leader in this story. August saw inflows of nearly $600 million from Chilean pension funds just into local equities. And calling that significant, well, it's an understatement. It was the single strongest month of net domestic investment they've had since 2021.
Just in 1 month, $600 million.
Yep. But it's not just 1 month that stands out. That surge in August, it pushed the year-to-date inflows to a really historic level. 2025 is now actually on track to be the biggest year for net inflows into Chilean equities since before the global financial crisis.
Wow, since before 2008.
That's right. Think about the sheer weight of that capital coming back into the market. And as a result, their local equity allocations as a percentage of total assets jumped pretty dramatically, up to 8.5%.
Okay, 8.5%. What was it before?
Well, it had troughed below 6% just a couple of years ago, so that jumped to 8.5%. That's a 7-year high for them. And when you're talking about funds this size, a 2.5 percentage point increase in allocation, that's a huge rebalancing.
And that kind of money moving must have shown up on the charts immediately, right?
Instantly. The technical validation was right there. Chile's benchmark index, the IPSA, rallied over 9% in August alone. This wasn't just retail speculation. This was aggressive institutional volume providing real fuel. It allowed the index to break cleanly through some key resistance levels, those ceilings that had kind of capped gains for months.
Okay, so the broad market moved, but where did that money actually go? You mentioned conviction.
Right. Let's zero in on that because the concentration is, frankly, stunning. Almost $500 million, nearly that entire $600 million monthly flow,
Yeah.
went into a single stock, LATAM Airlines.
Wait, $500 million into LATAM, the airline.
That's right. Almost the entire net inflow for the month piled into LATAM. It instantly made LATAM their single largest domestic equity holding.
That's incredible.
Yeah.
That's not just buying shares. That's a massive statement, isn't it?
It's a generational bet, essentially. A huge vote of confidence in the company's turnaround after restructuring, yes, but also in the broader recovery of Chilean travel and domestic demand.
So if they're buying LATAM so heavily, what else were they buying? Or were they selling other things to fund that?
That's the other interesting part, the rotation. It really highlights this consumer rebound theme. Other big beneficiaries were retailers, like the giant Cencosud and the mall operator Mall Plaza, so clear consumer plays.
Okay, consumer focused. Makes sense.
But here's the key insight. Look at what they were trimming or selling. Some traditional Chilean stalwarts, names institutional money usually leans on, they saw net outflows or at least trimming. We're talking about the big lithium producer SQM.
Oh, interesting, given the global EV story.
Right. Also, the major bank, Banco Santander, and retailer Falabella saw some trimming by the pensions.
So moving out of a global commodity play like SQM and maybe a stable financial like Santander.
And into things directly tied to the domestic consumer recovery, like LATAM and Cencosud.
Exactly. Why that shift? Why turn a cold shoulder, relatively speaking, to those stalwarts now?
It signals where they see the biggest upside potential right now. They seem to be saying the major growth is now in the internal Chilean consumer story. They're betting that the really painful economic contraction phase is over. You know, commodity exporters like SQM were maybe the lifeline during the tougher times. But now it looks like these institutions see better relative value and, frankly, more growth leverage, or beta, in discretionary spending plays. Think about it. A post-restructuring airline or a recovering mall operator probably offers more upside potential than a stable bank right now. It's a fundamental shift, moving from a defensive posture to a more offensive growth-seeking one.
And was this just the pension funds? Or did other institutions follow suit?
Good question. Mutual funds largely confirm the trend. They also reversed their previous outflows. And they hit their highest equity exposure levels since way back in 2019. Interestingly, though, on the mutual fund side, Falabella, which the pensions trimmed a bit, actually saw inflows, along with CMPC, the pulp and paper company. So the overall confidence is returning across different institutional types, even if the specific stock picks vary slightly.
Okay, so Chile is a very clear story of conviction and rotation. What about the other Andean markets? Let's talk Colombia. It's been a paradox, hasn't it?
Yeah, Colombia is fascinating. It's actually been the region's best performing equity market this year to date. But for most of that time, local pension funds were actually net sellers. Outflows topped $200 million over the past year or so.
Huh. So the market's rallying, but the biggest local players are selling. Why the disconnect? Was it political fear?
Yeah.
Regulation?
Probably a mix. Definitely deep political apprehension, maybe some regulatory pressures lingering too. They seemed forced to stay cautious, even while company earnings were maybe improving underneath. And here's the shift. August finally broke that selling streak. It was modest, only about $6 million in net inflows.
Okay, tiny compared to Chile.
Tiny in dollar terms, yes. But symbolically, it's potentially quite significant. What's fascinating is the psychological impact. If domestic support finally starts to align with the market's performance, well, that provides fresh, consistent fuel for the rally. Fuel that international investors will definitely notice and respect. And we are seeing their local equity allocations start to creep up now towards 8% of assets, hitting the highest level in years there, too.
So that 8% mark in Colombia becomes a key level to watch. If they push past that, it could really add legs to the rally.
Okay, and what about Peru? How does it fit into this picture?
Peru's path is less explosive, more quiet, steady resilience, I'd say. Local equity allocations there also nudged a bit higher, reaching around 16.5% of assets.
16.5%. That sounds quite high compared to Chile or Colombia.
It is, relatively.
Right.
Peru's pension system has historically had a higher allocation to domestic equities. But the key takeaway for Peru isn't aggressive buying like in Chile. It's more about stability and absorption. They are making huge half-billion-dollar bets on single stocks, but their consistent, steady presence provides really valuable liquidity for the local market. That steady hand helps the Peruvian market absorb all the political noise, the regulatory headlines, the commodity swings, without the super high volatility you sometimes see elsewhere.
So they act like a buffer almost.
Kind of like
Okay.
a foundational backstop.
Yeah.
Yeah. Okay, so we have Chile with strong conviction buys, Colombia maybe starting to align, and Peru offering that steady stability. Putting it all together, what does this return of the big local institutions really mean for the Andean markets overall? It feels like more than just a temporary boost.
I think it is. It's potentially a structural shift in domestic liquidity, and that creates opportunities. First, and maybe most importantly, you get much stronger domestic liquidity support. That tends to reduce volatility. It offers stability compared to relying just on that fickle global hot money.
Right. Cushions the market a bit.
Second, it really validates that bet on a consumer and retail recovery. We talked about Latam, Cencosud, Mall Plaza. The institutions are putting serious money behind the idea that stabilizing economies will boost spending and earnings there. And third, valuations. Even after this recent run-up, Andean equities generally still look cheap compared to global peers. These institutions moving in signals their confidence that those valuation discounts could narrow further.
Okay, clear opportunities. But we can't just focus on the good news. There are always risks, right? What could derail this whole comeback story? What are the big headwinds?
Absolutely. We have to be realistic. The first major risk is always policy and politics in this region. Things might seem calmer now, but, disruptive regulatory changes or unexpected pension reforms can pop up. And those kinds of changes can quickly mess up the investment math for these big funds, maybe even forcing them to sell again.
Okay, policy risk. What else?
Second, there's concentration risk, especially highlighted by the Chile story. When you see such heavy, aggressive buying into just a few names, like that massive Latam position,
That $500 million.
it really amplifies the downside risk. If sentiment turns against that one key stock, it could drag down the whole pension portfolio much more than if they were more diversified.
Makes sense. One big bet goes wrong,
Yeah.
it hurts more. And the third risk, is it global?
It always is, right? Global macro risk hasn't gone away. If the US dollar suddenly strengthens a lot, or if US Treasury yields spike higher and stay there, or if we see a sharp downturn in key commodity prices, any of those could quickly reverse these positive flows we've just seen. Remember, these are largely export-driven economies. They're still very linked to global conditions.
Right, can't escape the global picture entirely. So to wrap things up a bit, this August surge was a really powerful reminder, wasn't it? Just how dominant these local institutions can be in shaping liquidity and sentiment in their own markets. Chile clearly led the charge, driven by that big bet on the consumer. Colombia is maybe finally starting to align its local money with its market's performance, and Peru is providing that quieter but important stabilizing support. It feels like the wind has genuinely shifted, at least for now, and the flow of funds is definitely with the bulls in the Andes.
That sums it up well. And maybe for you, the learner, the key thing to watch isn't just the daily stock index price. It's those pension fund allocation percentages. Keep an eye on that 8.5% in Chile, the move towards 8% in Colombia, Peru's 16.5%. When these funds step in at this scale, they're essentially making a long-term forecast about their local economy. So the final provocative thought might be, what specific economic conditions have to continue for this to keep going? Inflation needs to keep falling. Political stability needs to hold. What needs to happen for these institutions to push their equity allocations even higher beyond these recent 7-year peaks? That would be the ultimate sign of truly enduring conviction.
Something to definitely keep watching. See y'all in the next Pro Ticker Deep Dive.